All right, you see here, attempt number 2. Netflix here reported some earnings yesterday. You know what I mean? After hours, they report some earnings, and this bad boy's down afterwards. So what's going on? What happened with Netflix? Why is it down? Well, first I'd like to just take a look at this company as a whole. Really, you get a good picture here if you look a year out. This is a stock that, in a time when the market is up 30%, it's gone flat. I mean, it's completely flat. Obviously, on a 5-year basis, it's completely outperforming everything else. But still, this past year, that growth has really slowed down. And from their highs in 2018, back in June, this thing's down 20%, 20 plus percent. So something to consider. But what happened during these earnings that made this thing go down 3% so far today? We'll take a look and see what's going on. In my opinion, as I mentioned before, there's going to be 2 things that people are really looking for. Really, the main thing people are going to be looking for is going to be subscriber growth, and they're going to be looking for guidance. That's really just how it goes with how Netflix is right now. That's what they're looking at. So let's take a look at these earnings. Right now, they went ahead and posted a EPS of $1.30 per share, but that may not be comparable to the consensus. 53 cents per share. So I don't know what exactly they're talking about. It may not be comparable. They might have fudged some numbers around and done things a little bit differently this quarter around is my guess. But this revenue number of, 30.5% year-over-year increase, $5.47 billion in revenue. That's really nice revenue numbers. So obviously you like seeing that. Good growth for them. But what's dragging them down, as I mentioned, is going to be the subscriber growth, specifically U.S. subscriber growth, as well as some guidance. So, softer than anticipated subscriber growth in the U.S. Company reports 550,000 U.S. and Canada streaming additions versus 611,000 consensus and a guidance of 589,000. U.S. net adds are 420,000. 420. Woo! They smoke weed. Just kidding. That's bad. I shouldn't have said it. Sorry, don't ban me. 420,000. So that means, actually, obviously they added 550, but 130,000 people quit using Netflix as well. So just something to consider, that they're not just all gaining. They're certainly losing people as well. But international streaming additions were 8.33 million versus a 7.2 million consensus and guidance of 7 million. So total streaming ads were 8.76 million. Total memberships at the end of the quarter were 167.09 million. Look at that. So that's quality still. That is still quality. Quarter 4 streaming contribution margin increased to 39.3%. So a good increase in margin. Gotta love that. International contribution margin rate came in at 17.1. Operating income during the quarter rose to 459 million versus 260 million last year. That's a good increase. Good increase. We like to see it. But then we're going to look at this statement from Netflix. Our plan is to continually improve free cash flow each year and to move slowly towards free cash flow positive. Of course, they're negative because that's how companies are nowadays. For 2020, we currently forecast free cash flow of approximately negative 2.5 billion. Makes me want to vomit. Negative 2.5 billion? You Uber or something? Gosh dang. We'll continue to use debt to... Oh my gosh. Use the debt market to finance our investment needs? This is making me sick. Oh my gosh. They're raising debt? Oh my gosh. They're raising debt to survive. What is going on here? This company's been around so long and they're raising debt? Leaves a sour taste in my mouth. Just don't like it. I don't like these kind of companies. You've been around so long and you haven't found a way to freaking make money. I mean, what are you supposed to do here? They got so much debt on their balance sheet, yet somehow they can't find a way to make any money. You got to make some business changes. Gosh, I hate this. Sorry, I'm being too negative, but there's a good reason why I'm negative. Because I like my companies to make money. Anyways, their consensus revenue is going to be 5.73 billion versus 5.76 consensus, so a little bit below. But their EPS is supposed to be higher than consensus, so good for them. They need to make some money desperately. Quarter 1 net additions of 7 million versus a consensus of 8.5. So they're expecting less, quite a few less, 1.5 million less subscriber growth than this past quarter. So interesting to see what's going on there. Let's look at some of the in-depth numbers. You see a constant revenue growth quarter over quarter here. Pretty nice to see that. That's really what you're looking for, and you see the consensus is growing as well. Year-over-year growth right around 30% pretty consistently, which again is good for them. Operating income is so-so. This quarter was certainly a decrease from the trend, but next quarter they plan on making $1 billion, so good for them. I don't know if that's going to be possible, but who knows. Margin was down this quarter, but you know what? Margin says it's supposed to be up next quarter. Interesting. That net income line, I don't know if I like really all that much. This quarter was better than they've had. Next quarter is supposed to be good. So again, they're finding a way to increase money, but I don't know if that's necessarily gonna be accurate. Just makes me think. I don't know. So you got your global streaming paid memberships. That's increasing around 20% each time. Not bad. Not bad by any means. And net cash is what I hate. Look at that free cash flow number. It's. I'm sorry, I'm moving a lot, so the chair's squeaking. I'm going to get some WD-40 soon, don't worry. I hate this free cash flow number. It's horrific. $1.67 billion. This quarter just negative. Ugh, come on. Show me something good. Okay, here's a good chart. I'm going to show this. That's what we're going to do. We don't read, okay, here. We look at charts. We don't read. Show me this graph. So this 2020 forecast for quarter one looks like we're going back to 2016 numbers. That doesn't seem nice, right? That forecast is not showing growth by any means. There was growth from 2016 to 2017. Growth from 2017 to 2018, 2019 decrease really, and it's showing another decrease in 2020. I don't like that. I don't like those numbers. Come on now, give me a better forecast, guys. Yeah, you know what I'm saying. Get out of here. We don't want to see anything about this nonsense reading. We don't read. Reading's for another time. But here's a garbage Google freaking trends chart. Oh, who's searching more? Me. First off, you're comparing it to obviously the shows from other companies, right? Morning Show for Apple, Jack Ryan for Amazon, Mandalorian for Disney Plus. So let's be honest. Let's be clear. Okay, that's what we want to be, is clear. Jack Ryan's been out for over a year. You're comparing it over a couple month period. Obviously, the hype isn't necessarily there. The morning show, I mean, Apple TV Plus, no one's Googling that much, It's been on commercials all the time. No one's really Googling it that much. Sorry. It's just not how it's going. The Mandalorian, much better series. Much better series than The Witcher. So, sorry, Witcher. Quality show, but still, this is not a fair comparison here by any means. Disney Plus just came out. Of course, The Mandalorian's not getting as much traction, but it's still probably a more watched series than The Witcher was. Just gonna be honest with you. And certainly a better series. Come on now. Google search trends. What are you trying to show people? How desperate can you get? To me, that's just a childish little move here. Come on now, guys. We're adults here. We're not looking at Google search trends. Ha! Sorry, I'm being a little cynical here. You know what? It frustrates me. It's really just that free cash flow number just really has me mad already. Now I'm just trying to crap on them. I don't mean to. You don't want me to do that. I'm sorry. So let's look at these paid net additions here. That's really what we're going to look at in different sectors. So you got U.S., Canada, North America, really. Let's just say that. North American. Average revenue per user growing, which is nice. We do like to see that. Paid net additions of 0.55 milla, which is definitely a lot less than this time last year and quarter one of this year. That was a weird little muscle cramp. Sorry. Yikes. We want to compare now. Let's look at Europe, Middle East, and Asia. So we got here these net additions is actually increasing there, so good for them. Obviously, same levels as quarter one of this year, really. So nothing significant. A little bit lower than that. Latin America, paid net additions is increasing as well. I mean, still really just as similar as what happened, the same quarter last year. Nothing wild. And finally, Asia Pacific. You're going to look and see that these net additions are kind of stagnant. Nothing really crazy going on over here. What I did really want to show, though, is the average revenue per user. Latin America kind of not looking as fantastic. Asia Pacific not looking good. A little bit of decrease. Pretty stagnant here in Europe, but in U.S. Canada, which is not actually the bulk of their subscriber growth, they're growing revenue per user. So that's something to look at least. Obviously, you want to increase that average revenue per user. That's kind of the real thing of these internet tech companies. Their goal is to increase how much money they're making per person that's using their platform. It's not just growing that platform, but there comes a point in how do you increase that money once you've plateaued almost. You increase average revenue per user. That's really how you do it. So in terms of U.S. streaming here, just obviously you take a look here. Profit went down a little bit this quarter. Margin went down quite a bit. But paid memberships overall is increasing. Net additions not that significant. And international, though, you see a lot more of a change there, which is looking better. International's better for them right now. Obviously here you have Spencer freaking Wang. His name's Wang. Woohoo! That's really all I got for Netflix. Besides the fact that, you know what? I'm going to look at that balance sheet. Give me it. Give me this balance sheet right now. I'm skipping to it. Oh, frick. I skipped past it. Give me this balance sheet. There it is, baby. Current cash and cash equivalents of $5 billion. That seems pretty decent, right? Pretty decent. But, okay, good for them. But, oh my gosh. Look at these liabilities. Current content liabilities of $4.4 billion. So that almost already is the cash and cash equivalents made up just from the content liabilities there. Accounts payable makes it certainly equivalent. But then we're going to look down to total long-term debt. This line of $14.759 billion. Yikes. Well, that's what I got to show you. I'm pooping on them because it's not a company I would invest in right now. The value just isn't really there right now for me with how high the market is right now. I mean, this is a company that if we get into a recession-type environment, it's going to get hammered pretty darn hard, just in terms of stock price. Not necessarily saying that revenue or something's going to decrease, but like a company this overvalued just is going to get hit very hard once the market catches on. So that's why I'm not investing in it right now. That's what I got for you. Let's go.